Here, I'll start the recording right now. Just while anyone's on, any other questions that anybody else has before? I mean, we'll get started. We'll get started in a minute, and I'll leave questions for everybody to ask. The traditional sort of 5 minutes to ask questions before I start talking, and then obviously we'll have time at the end. I hope you guys enjoyed the readings for this week. And then we'll see. I think there's some people still getting on. So
I see through the reading, like my understanding, the investment game is what the asset can do rather than what other people will pay for the asset. So in that circumstances, the way you explain, like say 7% earning yields plus 2% dividend, 2% growth or 3% growth, like say 10%. And the way we're gonna get the return, say 2% dividend yield and 7% reinvestment, and that reinvestment will reflect in the capital acquisition. That's my understanding. The whole return will come from that.
Yeah, I mean, effectively, it'll come from the growth of the earnings, right? And companies can do lots of things with their earnings, right? They can pay it all out as a dividend. They can buy back stock. They can invest in the business. They can buy other companies. They can repay debt. If they repay debt, that lowers their interest costs, which increases their earnings. So there's lots of different ways that companies can, use the earnings to kind of create value, right? I think is the point. But the overarching point, and I think the kind of the point that's probably most important is, it's not like, I'll say it this way, right? I'd rather be roughly right than precisely wrong, right? It's a way to kind of give yourself a foothold, a benchmark, right? Like just because you think the stock is going to return 10%, right? And maybe you make 9%, maybe you make 11%, right? But it's not going to be off by that much. And again, this is over time, right? If you're a real long-term investor. So, but yeah, the way you make money, is obviously dividends if the company pays dividends, and then if over time the value of the stock, the value of the business should go up, which if the earnings go up, the ability to do dividends, buy back more stock, all that sort of thing comes into play. And I mean, even though we try to think of it as we're never going to sell these stocks, right? In reality, they're liquid, and you do have the ability to take advantage of liquidity. It's not like, but you shouldn't be reliant on the market for your return, is basically the point.
Do you have a certain benchmark like 9% to 11%, or just it depends upon the other assets return? So it can go up and down based on the, say, like a bonds rate, or say junk bonds rate, or say.
Yeah. So the question MD is asking is there a certain benchmark? I mean, look, this is where last week I was saying about how I think investing is a little bit personal, where you have to think about what your own opportunity cost and hurdle rate is. But you can definitely use the historical benchmarks of, okay, if I invested in equities historically, I made, let's say, 9%, 10% in equities. And the other benchmark you can always use is just look at where, what like I said, what's your alternative, right? Where are interest rates, right? Where are bond rates, treasury rates, credit, corporate bonds, junk bonds. That again gives you maybe another benchmark of like, how much you could make in sort of the alternative. Okay, since it's past the start time, like I said, let's use these few minutes. I don't know if anybody else had any questions besides MD on any of the readings or anything else. And if not, we'll get started. And like I said, I'll leave time at the end as I normally do. But anyone else have questions about last week's readings before we get started? I mean, hopefully I'll be answering a lot of the questions during my comments, but just if anyone had anything off to start with. Okay, well then let me get started. Let's start with the share. Okay, so all right, so we are in week 6. Time flies. I can't believe we're kind of coming up near the end of it. Anyways, so welcome back to class. It's been a week. Hope you guys, like I said, hope you guys enjoyed the reading. I apologize. I'm a little bit under the weather, so my throat's a little bit scratchy. So if I sound a little bit hoarse, just pardon me for that. But yeah, let's get started. So here we are. So again, the agenda for today, I'll do kind of a quick recap. We'll talk about Gordon growth. The bulk of today was really going to be talking about how Buffett has applied Gordon growth and, really seeing how he's applied it. And then, obviously we'll summarize kind of the key takeaways and then, leave time at the end for questions. So let's start with the recap. So again, just, we've come a long way in the last 5 weeks. So one, investing is a loser's game, why most active managers underperform, how investors and markets really operate, how to think about volatility and how to deal with volatility and market timing, how to think like a handicapper. And then last week we kind of started talking about intrinsic value and margin of safety and what I really think is the power of the Gordon growth model. And so this week really is focused on how Buffett applies Gordon growth to his individual investments, but then also how we can use it to calculate different asset level returns. And so hopefully those two things, obviously we care about individual investments, but we also want to just generally have a good sense of when are more or less attractive times to be in stocks or bonds or other asset classes. So let's talk about Gordon growth, because I think there was a couple of things that came up last week that I just wanted to fully address, right? So first off, right, I talked about Buffett's reasoned rule, right? So I proposed that he follows a simple rule. One, that the earnings yield alone provides an acceptable return, followed by 2, that the business is almost certain to grow in the future, right? So the goal of this week is really to hopefully prove to you and demonstrate to you that this is, I believe, what he uses, and show you, how exactly he uses it. But before we go to that, I want to talk a little bit more about just Gordon growth, because I think there's some interesting non-obvious takeaways from Gordon growth, because I noticed it from some of the questions I got. So first of all, let's just go back. This is the Gordon growth equation from last week. I really think that it's really the part on the right, R equals E over P plus G, where the term E over P is really the earnings yield, the inverse of the PE ratio. And that's the part that is kind of safer. It's the part that's either known or easily estimated. And then G, which is the perpetual growth rate, right? That's obviously the riskier, more uncertain component of the return. But here's a couple of things that maybe, doesn't seem naturally intuitive, right? One is, where are we? Sorry. We can really think about Gordon growth as how to explain stock price volatility, right? So we know from our readings about Peter Lynch and some of these others that stock prices are extremely volatile, right? And so we've probably all experienced something like this, where we see a company, they've only missed earnings slightly, but the stock reacts pretty drastically, right? Why is the stock down 20%? And when you put this in the Gordon growth framework, I think it helps to crystallize it a little bit more, right? The important point is that large changes in price only lead to small changes in expected return, right? And let me show you what I mean by that. So here we are. This is the equation, the Gordon growth equation. Now, I've assumed you have a stock trading at $25 with an expected earnings of $1. So that's the 25 and the 1, or the 1 over 25, the earnings yield of 4%. And then I've just assumed a 4% perpetual growth rate, right? So that's gets you to a total of an 8% expected return. Now, let's say the company reports earnings, they miss. And in this case, they miss earnings by 10%. So the dollar becomes 90 cents. The stock falls 20%. So the stock goes from 25 to 20, and no change to the long-term growth. And this is what happens to you, right? So instead of $1, you have 90 cents, the 0.9. Instead of $25, the stock goes to 20. Again, the 4% perpetual growth rate hasn't changed. And what do we see, right? The long-term expected return only went up by 0.5%, right? So large change in the stock price really didn't change significantly, right? 0.5% here and there, I'd consider a rounding error. It didn't really change the long-term return equation, right? And so when you think about it, when you have times when, let's say interest rates change very drastically, or the perspective of a company changes, the investor's perspective of a company changes, why do stocks react as violently as they do? And I think this is a really good explanation for why they do, because really you need to have very drastic changes in prices to really change the long-term return equations. There's also a question, right? It was asked last week, and then I think it was also asked on Canvas, right? Can Gordon growth really apply to growth stocks, right? And I think the general bias is it can't, and I'm going to try to argue why I think it can. So again, let's take an example, right? Here you have a growth stock, right? Let's say it's considered a high growth stock, so it's trading at 50 times earnings, right? Or $1 of earnings for every $50 of price, so that's the 1 over 50, or 2% sort of earnings yield, plus again a perpetual growth rate of 4%, right? Again, remember it's a perpetual growth rate. That's why I'm just taking an assumed 4%. And you can pick a different number, whatever you think, but I don't think it's going to change the broader takeaway. Now, you see here the long-term expected return is 6%. Okay. Now, let's say you have a company that the earnings grow at 15% a year for 5 years. The stock goes nowhere in 5 years, and the return goes from all of 6% to 8%. Okay. So the earnings have doubled. 15% earnings growth for 5 years is actually a pretty good growth rate. Not too many companies can maintain that level of growth. And you have a stock price flat for 5 years, which I think most people would be pretty, unhappy with. And you have instead of owning a stock where you have 6% long-term returns, after 5 years you have a stock that has 8% long-term returns. Let's actually be a little bit more probably realistic, right? Let's actually assume that the stock just goes up with the market. Let's say it just goes up 10% a year. The earnings still double. The stock, instead of $50, goes up 10% for 5 years, so it becomes a little over $80. Again, the same 4% long-term growth rate. And you see that, the return has gone from all of 6% to 6.5%, right? And again, I think if you're buying a growth stock, you probably won't be happy with just getting a market return, right? The point of this, the point I'm trying to, hopefully that's clear. And if it's not, we'll obviously spend time at the end talking about it, right? But the point is that even high growth doesn't drastically change the implied return, the implied long-term returns, right? So if you didn't like the stock at 6%, or you didn't want to, and if you waited long enough, like maybe you got up to 8%, right? But again, that's after sitting in something that doesn't go anywhere for 5 years, or you're still stuck with a 6.5% return if you get a market return over that time frame, right? So the point being is that you can have a really good growth stock and still pay too high a price. And you end up with these, growth stocks in purgatory, in many cases. So let's see a real life example. So Microsoft. So most people nowadays think about Microsoft as, again, one of the Magnificent Seven, one of, kind of the top stocks in the world, and it is. But people forget that, from the year 2000 to 2015, the stock really didn't do anything, right? Over that time, the earnings did continue to grow, right? Like that's kind of the part that people forget is that, earnings in 2000 were 78 cents and they went all the way up to $2.52. So it was 7.6% annual growth, which, maybe isn't a blowout number, but it's frankly not a bad number. Unfortunately, the problem was that in 2000, Microsoft was trading at 74 and a half times PE, and by 2015 it was trading at 22, right? And so, the way I think about it, or way you could think about it, is really the implied returns went from 5.5% to, roughly 5.5% to 8.5%, right? And all I'm doing there is I'm just taking the earnings yield. So 74 and a half is roughly 1.5% earnings yield, and adding 4%, and 22 is roughly 4.5% earnings yield, and again adding 4%. So that's how I'm getting to 5.5% going to 8.5%. Now, the problem is in the year 2000, right, when Microsoft was trading at a 1.5% earnings yield, right, bonds were really at closer to 6.5%, right? So Microsoft, you couldn't have really thought of it as, a bond with growth, right? Which is kind of what, when we think about when we read about Ben Graham and, margin of safety and stuff like that, that's really what we want. And, we had a lost decade and a half. So you could basically see that, Microsoft stock fell and then basically traded, between 20 and $30 for, almost 13 years, 14 years. It's quite a while. And then it wasn't really until 2015 that it kind of got back up to where it was. So over that time frame, your total return owning Microsoft was all of 1.9% because the stock was flat and you got a little bit of return from the dividend. Now, since 2015, Microsoft has had a little bit of a rebirth. So from 2015 to 2024, the stock has gone up about 27% annualized. So pretty phenomenal. I don't think many people would have predicted this kind of acceleration in the earnings growth. Most of the people did not predict that Microsoft would pull off, Azure and its transition to the cloud. And you can see, earnings have really accelerated. So earnings went from $2.52 to $14 and change, roughly 20%, 21% growth. But equally, or not equally, but as valuable, or secondarily important, right? The PE multiple also did increase. It went from 22 times to close to 30 times, which added about 3.5% to the annualized return. But what you see is that the implied returns in this case have only gone from about 8.5%. Again, I'm just taking the inverse of the earnings yield and adding 4%, so roughly 8.5% to 7.5%. Now, what's different for Microsoft at this point is in 2015, treasuries were really yielding only 3% at that time. And so you can see Microsoft in 2015 was yielding about 4.5%, right? The inverse of the, 22 times earnings multiple. So it was better than a bond. And, the business was growing, right? It was growing before 2015, and obviously the growth accelerated, but, continued to grow. And you can see this wonderful stock chart that I think everyone, would love to have in retrospect of Microsoft's performance. So, hopefully that kind of gives you a sense of why, even for, we've talked about this in the past, but even for growth companies, it's very, very, I think it's still very, very important to not overpay for growth. and to not pay too high a multiple, even for growth, and why Gordon Growth can work even for growth companies. The other question that came up last week, and I inserted this into the presentation because of it, was this question, right? Do other investors use Gordon Growth? Now, I think there was some level of question of like, okay, this is really great in theory, but do investors actually use this? And so I thought I'd, spend a few minutes talking about this. So, we talked last week about, obviously, we talked about how Peter Lynch uses it. He uses Gordon Growth when he's thinking about valuing stocks against bonds. Todd Combs, who works for Buffett, talked about the rule that he uses with Buffett to find stocks. And that's how they found Apple. They look for companies trading at 15 times earnings with a 90% confidence that the earnings are going to grow and a 50% confidence level that they're going to grow at around 7%. And then the third one I was going to mention was Lou Simpson, right? So who's Lou Simpson, right? Well, he worked for Geico. So Geico is the auto insurer that's owned by Berkshire Hathaway, and he managed an investment portfolio of Geico. He managed it for, I believe, over 30 years, and over that time frame, he outperformed the S&P 500 by about 7% a year. So pretty stellar long-term results. So, and you can find this online, but he kind of outlined his 5 points of his investment philosophy. We're only going to go into one of them, right? One, think independently. Two, invest in high return businesses that are run for shareholders. Three, this is the one I want to go into more, pay only a reasonable price, even for an excellent business. Invest for the long term, and don't diversify excessively. And when we go to the point where he talks about paying only a reasonable price, his first comment is even the greatest business is not a good investment if the price is too high. So that's very similar to when we think about, what we read about horse handicapping, Christ on value, right? What's the difference between handicapping and betting? But he goes even further. Price to earnings and its inverse, the earnings yield, are useful gauges for valuing a company. So again, earnings yield, whenever you see earnings yield, at least for me, I start to think about Gordon Growth. And he ends by saying, a helpful comparison is the earnings yield versus the return on long-term U.S. government obligations. So he's basically comparing the earnings yield to yield on treasuries. And basically, he's looking for companies where you can make more than treasuries with kind of the likely or expected growth providing the upside. Okay. Well, these are all people sitting in sort of the orbit of Berkshire Hathaway. Does anybody else outside of Berkshire Hathaway use it? Well, Bill Miller, right? If you don't know Bill Miller, he ran the Legg Mason Value Trust Mutual Fund for many years. I think his claim to fame is that he outperformed the S&P 500 for 15 years in a row. And you can see from some of his writings, he uses Gordon Growth. So in his 2020, Q2 2020 letter, this is what he had to say. In the US, bonds have never been more expensive than in 2020. The S&P yields 3 times what a 10-year treasury does. So he's comparing the earnings yield of the S&P to the 10-year treasury. At that time, treasuries were about 1.5% yield, or about 66 and a half times PE multiple, if you really think about the PE multiple on a treasury. And the S&P at that time was trading around 20 times, probably depressed earnings, so 5% yield. And then he also does say that, the dividends grow over time. I think what he's trying to say is that earnings also grow over time while treasury payouts don't. So he's really, again, you see this example where he's taking the earnings yield, comparing it to treasuries to decide the attractiveness of stocks, and then adding to the attractiveness of stocks is the fact that they grow when treasuries, bonds do not. Okay, so that's Bill Miller. Anybody else? Yeah, one more, or a couple more. Howard Marks. So again, if you're not familiar, Howard Marks, he's the founder of a firm called Oaktree, which is kind of known as a credit value distress shop. He's run, he's written a couple of books. I think one of them is called The Most Important Thing. And he's written a bunch of investment memos for years. It's pretty well known that Buffett reads Howard Marks's memos. And so he wrote a memo back in 2013 called The Outlook for Equities, which is where this is from. And what he says is a better measure of stocks' long-term potential may be found in their earnings yield. So again, talking about earnings yields. And to gauge the relative price attractiveness, it isn't unreasonable to compare the earnings yield of a stock against the yield of a bond. And so again, taking the earnings yields of equities and putting basically making them look like a bond, and how would they look like as a bond? And then I'm going to end with somebody else, a different person, Stanley Druckenmiller. If you've never heard of Stan Druckenmiller, he's probably considered one of the best traders and hedge fund managers of all time. When he used to work for George Soros back in 2000, he broke the Bank of England, where they forced the pound to go off of the peg. So, he's known as a macro trader. And this is a clip from CNBC on January of this year, talking about the Trump administration. So I'll play this short clip for you.
So the economy looks very, very strong.
So, sorry. I clicked on the wrong thing.
At least for the next 6 months, which is about as far out as one can see with any degree of confidence. In terms of the markets, I would say it's complicated. Despite what I just said about all the wonderful things about the economy, we have an earnings yield to bond yield, probably the most unattractive level, not probably the most unattractive level in 20 years. So you're going to have this push of a strong economy versus bond yields rising in response to that strong economy. And that kind of makes me not have a strong opinion one way or the other on the market.
So again, what he said is, we have an earnings yield to bond yield that's the most unattractive level in 20 years. So again, he's taking the earnings yields of stocks, comparing it to, the yields on bonds to gauge the relative attractiveness. But then he's also talking about the growth. We do have economic growth, and so he's really talking about the push and pull. But why he's not necessarily bulled up on stocks. So hopefully that kind of gives you a little bit more comfort that this is stuff that real practitioners, real investors actually do use, whether they call it Gordon growth or not. So let's now switch and just talk about, let's talk about Buffett a little bit. Let's talk about equities. The first thing that you guys read was about Freddie Mac. It was an article called "A Warm Tip from Warren Buffett: It's Time to Buy Freddie Mac." I thought it's important. I thought it's interesting because historically Buffett has never, he's shied away from stock tips. I think this is probably one of the few, if only, times he's ever written something. But I think it's important because it kind of helps you, or at least it helps me, kind of think through his thought pattern, right? And so what were the main points from this article, right? The first thing he says is Freddie Mac is a triple dip. What does that mean? You've got a low price to earnings ratio on a company with a terrific record. So when he wrote this, Freddie Mac was trading at about less than 8 times estimated 1988 earnings, which is basically a 12.5% earnings yield, right? The second part of the triple dip is you've got growing earnings. So here he says, the market for conventional residential mortgages are growing at a 13% annual rate. And then he also goes on to say lots of potential growth. Only 33% of mortgages are securitized. So, and again, without going into too much detail, what Freddie Mac and what Fannie Mae do is they buy mortgages, they package them up, and they issue securities. So that's what it means by securitized. And then he makes another point that, because of some of the bank rules changing, that, more banks and more S&Ls will be incentivized to hold securities over loans in the future. And that Fannie and Freddie have a 90% share. So it's the next best thing to a monopoly. And then the third part of his triple dip is you have a stock that's bound to become much better known, right? So previously, the only people who were allowed to own Freddie Mac were the Federal Home Loan Banks, which are the banks that have helped create Freddie Mac. and the FHLB members were selling Freddie to raise capital. And I think when he wrote this, Freddie Mac was still trading over the counter. It hadn't been, it hadn't gone yet on the New York Stock Exchange. And so when we think about this, again, these are kind of the high level points from the article, right? But when we think about this, how did Buffett sort of probably in our mind assess Freddie Mac, right? Well, he probably thought something like this, where I have something trading at about 8 times earnings, so a 12.5% yield with some growth, right? Something I don't know. And so, I'll make at least 12.5% and probably more, since it will likely keep growing. And for perspective, the yield on 30-year treasuries in 1988 was about 8.9%. I know those numbers are hard to believe nowadays when, yields are 4% or less, but that's where they were at. And so you have something where it's like, okay, well, this looks like it's better than a treasury bond, and it continues to grow. And so how did Freddie Mac do? Well, you can see right off the bat, right? Freddie IPO'd at around $4, and within a year it was at $8. So it pretty quickly doubled right after its IPO. And then it took a long tumble from about $8 all the way down to $2. Some of you guys are probably too young to know this, but there was something called the S&L crisis that happened in the late 80s and early 90s, where a bunch of banks, savings and loans, basically had to be bailed out by the government, and for lots of different reasons I won't get into. But if you had held on to Freddie through all that turmoil, and again held it for 5 years, you would have still tripled your money over that time frame, even with losing 75% of your money along the way. And if you had bought kind of at the bottom of the S&L crisis, you would have made probably 6 times your money or more. So Freddie Mac obviously turned out to be a great investment. But to me, what I think is important is really going back to here, right? This is how, and again, for all of Buffett's sort of knowledge and sophistication, I think the analysis was pretty simple, right? You look at this, you say, okay, am I making an acceptable sort of return if this business doesn't grow at all? Does it look better than a bond? And then, am I likely to get the growth, right? And, like I said, the growth was very likely because of just all these other dynamics in the market where, we've talked about like the need or the ability to kind of forecast the future. And here it's a way where you don't really need to be precise about forecasting the future, but you just need to understand some general trends, right? Mortgages are growing, more of them are being securitized, the rules in the banking system are changing, and Fannie and Freddie control 90% of the market. So they'll reap all, or most of the benefit of the growth, right? And just knowing that, you could have made a pretty healthy return. So let's just now switch to the second article I had you read. It's called "You Pay a Very High Price in the Stock Market for a Cheery Consensus." This is an article Buffett wrote for Forbes magazine all the way back in 1979. I was 1 year old at the time. I wish I had read it back then. And what you see, or what we'll see, is that he kind of uses the same framework for assessing the attractiveness of equities generally, right? Buffett was actually very bullish on stocks at a time when most investors were not, right? It's very different from today, right? If you look at today, Berkshire Hathaway is building cash, they're selling stocks, they're not even repurchasing their own shares. And so the first thing that he says is that stocks now sell at levels that should produce returns far superior to bonds, right? So right off the bat, what do we see? Buffett looks at the returns of stocks generally and compares them to the return of bonds, right? So that's how he sort of thinks about it. And then he goes into more detail. He compares the yield on equities, which at the time was 13%, to that of long-term bonds. And this is what he says. can better returns results be obtained over, say, 20 years from 9.5% bonds than from equities purchased at book value and likely to earn around 13% on that book value. So they're earning 13% on book value. The price is trading at roughly book value. That's basically the same as saying that they're yielding about 13%. And if you think about how he would have probably framed it, he probably would have framed it as, I'm making 13%, my yield on equities, plus whatever growth I get out of equities, and that's better than 9.5%. So right off the bat, when you read that second line, right there, hopefully, it makes you kind of question it, right? Why does he say it that way, right? So Buffett says that stocks are trading at book value and earning 13% on book, right? Why not just say that stocks are trading at a 13% earnings yield, right? And I think this is an important point, right? He's trying to make a point that he's fine with the companies not paying out their earnings and retaining it. And let me explain why, right? If companies were earning, let's say, 6.5% return on equity, right? That's the returns they're making on the equity that they have, and trading at only 50% of book or half of book value. In the market, they'd still be trading at a 13% earnings yield, right? 6.5 divided by 0.5, 13. But in this scenario, you wouldn't want them to retain their earnings and reinvest. If they're reinvesting those dollars and only making 6.5%, right? Because in that case, they're better off taking that money and investing it in bonds and making 9.5%, or paying out that money to you and letting you put it into bonds and earn 9.5%. So that's why Buffett says it that way. Is he's trying, without him coming out and saying it, what he's trying to say is, you're going to make a 13% earnings yield, and even if the companies don't pay out that money, they're going to reinvest it and make 13% on the money they keep, and that's better than them paying it to you and you putting it in a bond and earning 9.5%, or them taking the money and putting it into a bond and earning 9.5%. But if returns were only 6.5%, right, then the equation would change. And so how could stocks be worse? Equities would prove inferior only if there's a major sustained decline in returns on equity, or a ludicrously low valuation prevails at the end of the 20-year period. Stocks would only do worse, basically, if the earnings power declines substantially, which I don't think, Buffett, I don't think believe, and I don't think most people believe, that the earnings power of corporate America was going to decline sustainably. And if the current low PE multiple declines significantly. So think of it this way: you already have a very high earnings yield, which is what makes stocks attractive. If at the end of those 20 years, the earnings yield is even higher, right? And that's with all the growth and everything else, then, stocks may have done worse. But at that point, stocks are even more attractive than they are today. And, Buffett already thinks that they're sort of screamingly attractive. And, finally, he ends by, talking about uncertainty as the investor's friend, right? He says, the future is never clear. You pay a very high price in the stock market for a cheery consensus. Basically, when everybody's feeling good, prices are high, and, effectively returns are low, right? And, he basically goes on to say, uncertainty actually is the friend of the buyer of long-term value, right? So when we think about uncertainty, I'm trying to just relate these ideas back to one another. But, to me, that really goes back to what we talked about with the equity yield curve, right? The way markets sort of tend to operate. When there's uncertainty, when things take time, that's when you can typically find, the higher returns. And then let's move then to the next one, Mr. Buffett on the stock market. This was written in Fortune magazine, almost exactly 20 years after the first the article we just discussed were. And, Buffett became a lot more bearish on stocks in 99 when most were bullish. So again, he's thinking about things in a different way. And in this article, what you see is he talks about GDP growth as sort of a limiting factor in equity returns. He says you cannot expect to forever realize a 12% annual increase in the valuation of American business if its profitability is only growing at 5%, right? And he says the value of an asset cannot over the long term grow faster than its earnings. And so what basically he's saying is that, well, corporate profits share of GDP at the time he thought was already pretty high. It was at the high end of its historical range. So corporate profits growth is really a function of both GDP growth and the share of corporate profits to GDP. And so since it was already high and he doesn't think it could go higher, at best, what corporate profits would probably grow would track GDP growth. So now he's talking about kind of the growth expectation, right? And so he thinks 5%. And then he makes another point about slim pickings, right? So he estimates that the earnings yield after trading costs of the S&P at that time was about 2.5%. And this is how he says it, right? The investor who owns the S&P 500 are reaping less than 250 billion return on their 10 trillion investment. So 250 billion over 10 trillion, which is the value of the stock market at the time, 2.5%. And Buffett says, in my view, that's slim pickings, right? And he argues that equities are priced for subdued returns, right? So he estimates that the long-term equity return should be around 6%. So again, let's put that into our Gordon growth framework, right? So again, return is the earnings yield plus growth. So he says the yield on the S&P 500 is about 2.5%, and then he's assuming about 5% growth, so 7.5%. So how does he get 6%, right? Well, I think first, and if you read the article, right, he notes that the 1% assumed transaction cost is probably low. So the 2.5% yield is probably too high. And then he also says that, the 5% GDP growth is pretty darn good, right? So what he doesn't say is that, corporate profits are also pretty high relative to GDP. And so if they declined, you could have a scenario where earnings grow slower than GDP. Again, let's not split hairs too much. 6.5, 7.5, 6%, 7.5%, you're in the same zip code. Now, what's important is in late 99, kind of when this article was written, the average yield on 30-year treasuries was 6.2%. So, the premium for owning equities was pretty meager. Now, again, what Buffett says is stocks would do better if either interest rates fell further or corporate profits, as a share of GDP rose, right? So if the already high percentage of GDP that goes to corporations, if that increased further, then maybe they would do better because they would grow faster than what he's proposing. Or if interest rates fell, then he thought that the required return on stocks could also fall. And so what are we seeing, right? Well, it was not really a great time to own stocks. So, if you look at it over 5 years, the total return of the S&P was negative 10.9%. It was about negative 2.3% annual. That's including dividends. Over 10 years, the market was, the total return was about negative 9.1%, about 1% negative annualized from 99 to 2009. But then if you extend it all the way out to 20 years, that looks like a nice chart, but that is 6% annual returns that's what 6% annual returns looks like over 20 years. So effectively 0 for the first half and then 12% for the second half. Now this is before transaction costs, right? Remember, Buffett assumed about a 1% transaction cost. So if those 1% transaction costs were right, then the net return to investors was closer to 5%. And that's, again, before any capital gains taxes, so maybe even worse. What's pretty shocking is, in '99 you were better off buying 30-year treasuries, right? So you made the 6.5%, and then obviously over those 20 years, interest rates fell. So your bond, not only did you make the 6.5%, but your bonds increased in value. So just buying the stodgy treasury bonds was better than trying to pick stocks or invest in the stock market. Now, there's a lot of things that actually Buffett was wrong about, right? Interest rates did fall, right? They went from, like I said, they were, interest rates were around 6.5% when this article was written, and 20 years later they were, right around 2%. So they fell quite dramatically, but it didn't really boost equity returns. And this is something we don't have a great answer to. We don't necessarily understand why, but I think that, frankly, there's a floor on where, investors, whether consciously or unconsciously, are willing to accept long-term equity returns, right? So even if interest rates go down to 2 or 3%, right, most people don't buy stocks thinking they're only going to make 3 or 4%, right? They want a higher return. And, when you think about where things trade and multiples and things like that, they don't move one for one with bond yields, especially when they get to these extremely low levels. And then probably also at this time, right, people probably also felt that some of these interest rates were artificially low. You have to remember there was things like quantitative easing happening, central banks sort of managing interest, interest rates to be pretty low. And so, I don't think they were necessarily looking at it the same way. Now, GDP did continue to grow fairly solidly. Over that time frame, GDP growth averaged about 4.2%. So, slightly below the 5% number that Buffett himself said was generous. Now, when you look at this, I think, again, it's interesting to just keep in mind that this is when the tech boom was happening, and you really don't see the internet sort of accelerating GDP growth. Or alternatively, maybe GDP growth could have been a lot worse without the internet. Give me 1 second, people. Let me just stop by the internet. Okay, I'm back. Sorry about that. And he was wrong about one more thing. Corporate profits share of GDP actually did continue to grow. So he thought 6% was pretty high. In fact, corporate profits have gone up to as high as 11%, and kind of ticked down a little bit to about 10%. So again, corporate profits percent of GDP did increase, but again, it didn't really boost equity returns. Earnings did grow faster, obviously, because of the share of GDP going to corporations continued to increase. But why didn't we get better returns? Again, we don't really have a great answer, but I suspect that people think that these improvements aren't sustainable, right? Today you see a lot of talk about wealth inequality and sort of rebalancing between capital and labor and things like that. But we don't have we don't have really great explanations. Now I thought this was interesting because there's obviously a natural question of where are we today. So this is the S&P 500 price to peak earnings. Now, why did I take the price to peak earnings? I wanted to compensate for things like when there are recessions. And basically, what I do is I just take the S&P 500 price and I look at whatever the highest earnings it's ever earned up until that point is. assuming that if the S&P 500 was able to earn that in the past, they'll probably be able to reclaim that. And you can see where we are today. And so you look at PE multiples today, we're not too far off from pretty high levels where we were at, in 99, sort of the peak of the tech bubble, where we got to in like late 2020, 2021, and here we are again, right? So if we convert that to estimated returns, so again, how do I do this? I just take the inverse of the earnings yield, right? And then I'm just adding a fixed 4%. That's my assumption for perpetual growth rate. Again, I'm more interested in being roughly right than precisely wrong. Now, what do you see? Right? Well, if you look at this big circle up here, right, that's the S&P 500 in March of 2009. It tells you expected returns are somewhere above 15%. And actually, if you had, invested in the stock market at that time and held it to today, you made about 16%. So I would consider that pretty good. If you look at this is March of 2003. You see you're probably a little bit above 10% there. And if you'd actually invested and held it over that time, you made about 11%. A year later, returns were closer to like 9%, and in reality, you've made about a little over 10% if you invested at that time. So it's not a perfect model, okay, but it kind of, like I said, puts you in the zip code. Now, if you look all the way here, this is April of 21, where returns were less than 8%. Well, actually, so far, you've made about 13%. But again, these are short-term results, right? Anything can happen in the short term, and one would argue that maybe you pulled forward returns from the future, right? So it's not perfect, but it's not necessarily even a terrible way to estimate long-term returns. But again, I want to emphasize that long-term returns, right? Anything can happen in the short term. Now, the other thing is we have to also think about opportunity costs. So we just looked at it, where the S&P is today. It's the multiple's not too far off from where it was at the peak of the tech bubble or kind of the peak of some other bubbles. So naturally, people have this tendency to say that we're in a bubble. Now, what I did here is I took those same returns and I subtracted out the returns from bonds. And so you can see in 99, returns on bonds, returns on stocks were pretty meager, but that's really because at that point, bonds were at like 6%, 6.5% plus. Today, you're closer to 4%. So on that metric, you could argue that, stocks might still be expensive, but maybe not as expensive as when we were at the peak of the tech bubble. But, should you expect, very robust long-term equity returns? I'd say probably not, right? And I think when people wonder why, Buffett isn't buying stocks or, keeping a lot of cash or, selling stocks or not buying his own stock, I think you probably get a good way just by understanding, this sort of stuff. Now, the last thing I want to talk about is Buffett's starting yield. So Buffett basically implies that he wants to buy equities when the starting yield is around 6.5 to 7%. So he wants to buy with a 6.5 to 7% earnings yield, or really think about it as, he really wants to buy stocks at less than 16 times earnings. And he actually has said this, this was in his 2002 letter to shareholders, right? Unless we see a very high probability of at least 10% pre-tax returns, which translate to 6.5 to 7% after corporate tax, we will sit on the sidelines. And he says, with short-term money returning less than 1% after tax, sitting it out is no fun, but occasionally successful investing requires inactivity. So this is, again, very similar, when we talk about the, with Todd Combs, the portfolio manager who works for Buffett now, said, they look for stocks trading at less than 50 times earnings. right? 15 times earning is really a 6.7% earning yield, and then growth. So that kind of fits with, this look at the starting yield. So that's really what I wanted to talk about from the equity perspective. There's a lot, in the Berkshire Hathaway snippets, the excerpts document that you had to read. There's obviously a lot more that we don't have time to go through, but hopefully, as you kind of read through it with the lens of the Gordon growth model, you come to a better appreciation of just how many times he sort of applied this framework without explicitly saying that. Let me quickly just talk about some of the other asset classes. So fixed income, bonds, right? So how can you use Gordon growth for bonds, right? So Buffett actually does use the same analysis in investing for bonds. We can talk about, one of the examples in the excerpts is this bond that they bought. It was the Washington Public Power Supply something, WPPSS. And they invested 139 million in these bonds, right? And he says we compare the 139 million cost of our year investment in WPPSS to a similar 139 million in an operating business, right? The business, which is the bond, contractually earns 22.7 million after tax, right? So he bought these bonds at a 16.3% yield. Now he says bonds have an important minus, right? Bonds coupons don't grow, and the price is capped. So the most the business could be worth is about 205 million. That was the face value of the bonds. And so he says that the ceiling is on upside is an important minus, right? So the return is really just the yield plus any growth in the principal value. So if you bought the bond at a discount to par, it would back up to par. But effectively, he's, again, hopefully you can see, he's using Gordon growth to think about how to value a bond, right? In this case, it's the yield, the 16.3%, and no growth, is really his base return. And then if the bond increases in value, you'll make a little bit of extra money, but that's all you'll be able to make. And then, he talks about the businessman's perspective for bonds, right? And he talks back, in 1946, 20-year bonds traded at slightly below a 1% yield. And so how should you think about that, right? And he says, in effect, the buyer of the bonds bought a business that earned about 1% on book value and paid 100 cents on the dollar for that abominable business, right? So basically, you're buying a bond for 1%. That coupon doesn't grow. And he again compares it to businesses. He says at that same time, businesses with excellent future prospects could have been bought at book value while earning 10, 12, or 15% after tax on book. Again, why is he talking about book value and companies earning 10 to 15% on book value and trading at book value instead of just saying they were yielding 10, 12, or 15%? Again, because I think he wants you to see that it's not just the fact that where they're trading, but it also matters, like, if they're earning attractive returns, then you don't care that they're retaining earnings, right? So similar to what we were talking about the other time with the 13% earnings yield and the return on the stocks. Now, let's just switch quickly. Preferred stock. So, in I think Buffett's career, if you look, he's really bought preferred stocks 3 times. The first time was in the late 80s and early 90s. He bought preferred stock in Salomon Brothers, Gillette, US Air, Champion, First Empire State Bank, which is now M&T Bank, and American Express. And what you see is each carried a coupon of around 9%, right, which provided the acceptable component of the return. And Berkshire profited from its ability to convert the preferred into common stock if the common stock went up. So again, we don't know this for a fact, but I think he thought of it something like this, where I make 9% and I have some upside if stocks go up. Now, when he invested in Salomon, he got a 9% coupon. At that time, treasuries were around 8.5%. So he's getting a little bit more than treasuries. But again, he had the free upside if the stock did better. And remember, right, in treasuries, right, the coupons don't grow. He invested a lot during the GFC, so he invested 33 billion in Wrigley, Goldman Sachs, General Electric, Swiss Re, Dow Chemical, Bank of America, and Heinz. Here he got again a coupon of 10%, which provided him the acceptable component of his return, and then he got the upside from conversion into common stock. So their Gordon growth equation probably looks something like this in Buffett's mind. And then in 2019, he invested another $10 billion into the preferred stock to help finance the acquisition of Anadarko by Occidental Petroleum. Again, you'll see that he got an 8%. This time he got an 8% coupon, but it's redeemable at 105 in 10 years. So basically, it's an 8.5% yield. But then he also received warrants to buy 80 million shares at $62.50 over 10 years. So when he got those warrants, at that time, Occidental was trading at $59. So he's basically buying 10-year call options, pretty much at the money. If you do a Black-Scholes valuation of those options, of those warrants, they were worth about 800 million at the time. So again, you can see that, in his mind, it was probably, I make 8.5%, and I've got the upside option from the warrants. Now, these preferreds look a lot like convertible bonds, right? So, but there's an important exception, right? So traditional convertible bonds really have pretty low coupons and some sort of conversion premium. Buffett's preferreds have a high coupon plus a conversion premium. So, just the other day, there's a company called AST Space Mobile, right? They issued $1 billion convertible note due in 10 years. But that convert pays only 2% interest. So slim pickings. And converts into common stock at 22, 23% premium to where the stock was trading. So not nearly as attractive as these preferreds that Buffett was able to negotiate for himself. And then real quick, we'll switch to the last, Buffett, the real estate investor. So, he uses these examples again to illustrate really how he's thinking, but it kind of fits into the same mold, right? In the two examples we'll talk about, he purchased with a 10% starting yield and where the earnings of the properties were likely to increase in the future. That's the upside. So he talks first about a Nebraska farm. He purchases a farm out of receivership from the FDIC. And he said, I calculated the normalized earnings from the farm to be about 10%. So he expected to make 10% normalized even if the business didn't grow in the future. But he said it was likely that productivity would improve, right? They would produce more volume over time and that crop prices would move higher, so the earnings would go up. And you see, I make 10% plus, likely I make, more with the growth. And he says, I needed no unusual knowledge or intelligence to conclude that the investment had no downside and potentially had substantial upside, right? And he says, since then, the farm has tripled its earnings and is worth 5 times or more what he paid, right? So he's now valuing it at roughly a 6% earnings yield. And then the New York real estate. So he acquired New York retail property from the Resolution Trust. So the Resolution Trust was created after the S&L crisis to dispose of some of the assets of some of these failed savings and loans banks. And he says, again, the analysis was simple. The current yield on the property was about 10%. And he says the largest tenant was paying about $5 a foot, whereas other tenants averaged 70. And so the expiration of this lease was certain to provide a major boost to earnings. So again, this meets Buffett's criteria for investing. The 10% yield provides an acceptable return. And the earnings were virtually certain to increase in the future. So again, 10% plus upside. So key takeaways. I think we can deduce Buffett's reasoned rule from his writings and the many examples he's given us. And I think what's equally important is across all investments, right? most investors tend to think of investing in stocks, investing in bonds, investing in real estate is very different. He actually uses the same general approach for all of them. And it's as we've said, an acceptable yield with virtual certainty that the future earnings will be higher. So next week, our second to last class, we're going to do an in-depth case study of Coca-Cola, one of Buffett's most famous investments. We'll understand its business, the management, the valuation. We'll do a lot more detailed analysis of the company. And really the question is, can we understand what Buffett saw when he invested? So the readings, which will be posted later tonight, there's two readings. One is the 1982 annual report, and there's a section particularly at the beginning called Strategy for the 1980s. And then the 1987 annual report. So the 1982 annual report, the reason I mentioned that one is because that's when the new management of Coca-Cola took over, Roberto Goizueta and Don Keough. And then the 1987 annual report, we know Buffett invested in 1988. He invested, pretty soon after Black Monday. So the 1988 annual report probably wasn't out. And so the 1987 annual report is probably the last, or the annual report that he really read when he decided to invest. I don't expect you to do, to read the whole annual report. First of all, they're scanned, so they're not necessarily that easy to read. And these are very old documents, but I do want you to just familiarize yourself with what Coca-Cola was at the time. And, like I said, I'll walk through it in class, but, it'll be helpful to just familiarize yourself with what an annual report looks like. So with that, that is kind of my comments for today. I'll stop the share, and I see a couple of hands already raised. And we will go from there. So I don't know who is owner, but owner.
That's Joel. Sorry.
Hi, how are you?
Good. Does Buffett use the growth as a margin of safety? Could I interpret that?
Yeah, I mean, I think you can. I think you can, because basically I think what he's trying to say is, or what he's trying to do is he's trying to basically buy something that, in his mind looks very bond-like or gives him a return better than his alternative. And then, as long as it grows, his as those earnings grow over time, right, his margin of safety would increase over time because, the company would be earning more and more on his original cost basis. So yeah, you could think of it that way.
Okay, thank you.
MD.
Yeah. So my understanding is that basically Buffett compares the equity yield with the other yields, and then he invests, rather than he takes G as an option. Like if it grows, is fine. If it doesn't grow, it's fine.
Yeah, I mean, again, I just want to be very clear. I don't think, when things are trading at, you don't see Buffett buying stocks at 25 times earnings, right? When interest rates are at 4% or something like that, right? I think he does have a minimum level, what he talks about, the 6.5 to 7% that he wants to make, right? And when he can't make that, and when interest rates are very low, I think that's part of the reason why you see him just sitting on cash, right? So I don't want to say that there's he's just looking at it at any price. I think there is a floor, a minimum that he's willing to accept, right?
So then how, for example, we saw a long time there was no growth in the S&P. So during that time, what should we do? Is still we're gonna invest in the indies, for the dollar cost average?
Well, I mean, there was no. I mean, you're talking about there was no return in the S&P 500, but when we're talking about 99 till, let's say 2019, right? Or, really it was 99 to 2009, right? So that 10-year period where the market didn't do anything, right? But that's also when, remember, the starting period of that was when the long-term return on equities was probably the same as buying just a treasury bond, right? So, had you kind of known this and like done that analysis, you could have taken your money and put it into treasuries. And had you put it into treasuries, like I said, you would have made 6%, which again, maybe you think is good, maybe you don't think is good, right? But you actually made a lot more than 6%, right? Because interest rates also declined pretty significantly over that time frame. But you didn't necessarily know that interest rates were going to decline. So you should have bought it thinking you were going to make 6%. But 6% in bonds versus 6% in equities, is probably, the risk reward was probably still better for bonds at that point. So it's not, equities did poorly, but that's just because there was some better alternative out there.
So when in terms of the indices, like multiple, like E divided by P, the percentage coming plus G, this G would be same G like for another company or different G. For example, you are assuming 4% for the indices. Will you assume the same things for the different company or different? It would be the rate.
Well, I mean, this, first of all, you have to assume that if the company can survive, right? See, this is right off the bat what we were talking about last week, right? This makes you think about the durability of most companies, right? And most companies, when you really think about them, you really try to question, are they even long-term sustainable, right? And I think with a lot of companies, you'll see the answer is probably not, right? So you would probably want to use a growth rate that is not that number, right? But you can, it's if like, I mean, we'll talk about it next week, right? But I think one of the reasons why he invested in Coca-Cola and not some other company is because he looked at Coca-Cola and he looked at kind of the power of the franchise and everything else. And, at that time, Coca-Cola had already been around for, 100 years and something like that, right? So it was much more likely to be durable than, some high-tech company, right? Obviously, you have a tech company, somebody else makes some innovation, some sort of breakthrough, right? That company is not going to exist, necessarily in the future, right? And I think that's the point that he's trying to make. So, if you can get comfortable with the long-term durability of a business, then you still have to think about, like, can this business continue to grow at market rates, or should you really be conservative and maybe even discount it at some rate less than what you think the economy is growing at, if that makes sense.
If we assume, say, both G are same, say 4%.
Wait, Emily, I just want to be, look, I know you have a lot of questions.
Yeah, I'll be back. Thank you.
Yeah, come back. Charles, I think, were you next?
Yeah.
Okay.
Thanks, Jay. So the first ones I did ask before is when you're waiting to buy stock, because it's not really all the time you can find a good stock, good price, margin of safety. So you just have to park your cash somewhere. My question really is, where's a good place to park in? You're parking the money market or QQQ SPILE? So what's your take on this kind of thing? I mean, where should we park our cash for certain amount of time? Sometimes a couple of weeks, sometimes it could be half a year, just waiting for the right stock to purchase, right?
Yeah, or sometimes it could be for the rest of your life. We don't know that, like, let's say the S&P 500, right, is priced for 7% long-term returns, right? And you can buy a money market at, let's say, 3.5%, 4%, right? And so one argument would be, well, I should take the cash and put it into these money market funds, because I think at some point the stock market will give me a lower, give me a higher return, right? The market will go down, I'll get a higher long-term return, and then I'll deploy that cash into into the stock market, right? But like, there's no guarantee, right, that that would ever actually happen, right? Like maybe the world has just changed and 7% returns, really the 10-11% returns of past were just, too high, right? People have talked about, kind of the long-term riskiness of stocks and why they generated such high returns. And so, there's an argument that, maybe you'll never make it. So, you might spend your whole life parking it into cash, waiting for a crash to happen that never happens. And then you'll have made a lower return, because 7% might not be that attractive or may not be that attractive to you based on history, but on future levels, maybe it's very attractive. So, we don't really know, right? But this goes back to, what was it, our second or third week where we talked about, that reading, even God couldn't beat dollar cost averaging, right? And
Okay.
effectively what he's saying is that, even if you knew that the market was going to crash, you're still probably better off parking your money in equities as long as, if you remember at the time, I made a caveat, right? I said the caveat was, I think there's a couple of times in history where you could pretty, you could tell when the returns on stocks were not attractive relative to bonds, right? And 99 was one of those instances, right? If you look at 1987, I think that was part of the reason why we had the Black Monday crash. But really, there's only been a handful of times, like the early 80s, and things like that, where the incremental return from stocks was likely not going to be much better than bonds, right?
Yeah.
Now, where are we today, right? Again, we could say the market's trading at, maybe somewhere between 25 and 30 times earnings. So maybe between a 3 and a 4% yield. And, if you think GDP growth averages around 4%, corporate profit, share of GDP doesn't really go down, maybe you get another 4%. So I think you're not going to be too far off if you talk about long-term returns of, let's say 7 to 8%, right?
Okay.
But, that's still better than 3% from your money market or 4% from your money market or bonds or something like that. So, it's unfortunate that it's just, we have a bad, you're in a restaurant and you're looking at the menu and everything in the menu is something you don't really like. So you have to just pick the least worst option, if that makes sense.
So maybe it's more like if I really can't find a stock to purchase at the moment, I just put money into the QQQ or Aspire. That'd be better than money market then.
Well, I mean, again, you're going to take more near-term volatility, right? Like, the market goes up and down 1%, fairly regularly. So, it partly depends on your own, your own ability to sort of stomach volatility. But, when we're talking about long-term returns, right? Like, again, I'm talking, you know, you know, multi-decade returns, or at least a decade returns, right? Then yeah, you'll probably still do better in stocks than investing in bonds at this exact moment.
Okay. The second one is when I look at the Warren Buffett today.
Wait, Charles, just look. Can you just get back in line? I just want to answer David and then Cameron and then
Okay.
and then I'll get
I
back.
want you to be pretty quick, but anyway, yeah, go ahead.
Okay, David.
Oh. Hey, thanks, Jay, for plowing through with this lecture despite feeling under the weather.
Oh yeah, sorry about all the coughing.
Oh, no worries. Hey, it's interesting you brought up the Occidental Petroleum investment, along with Coca-Cola. Coca-Cola is one of Warren's what he calls permanent investments, which he's only designated about 4 companies. I think it was Coca-Cola, American Express, Gillette before it was bought up by Procter & Gamble. And then last year he put Occidental in that group too, which is a very different company than the other 3. Assume when he bought most of his stock, I think Berkshire owns about 35% of the company, and he bought mostly about $50 to $60 a share for the common stock of Occidental. So if we try to reverse engineer it, I'm assuming that we think that he probably thought the earnings yield was going to be about 6% over an average year, I guess, and then get the 4% GDP growth to get like a 10% return. Would you think that's what he's thinking?
First of all, I will say I did not see that he had designated he just designated Occidental one of his like permanent holdings. So right off the bat, I'm a little bit surprised at that. So I must have missed it. Um, you know, again, I don't know exactly, right? But when Charlie Munger was alive, Charlie Munger used to talk about how, if we were really smart as a nation, we would not consume any of our natural resources and use everybody else's natural resources, because he thought that, oil was just going to become more and more valuable over time. So I don't know if Buffett necessarily believes the same thing, or he just views it as, an attractive equity. And again, you have to remember he has a big investment in the preferred stock, right? Which, I think is kind of the bulk of his investment. The bulk of, even now, probably the bulk of his investment. But so I don't know is really the answer. I don't know exactly how he thinks about it, or if he has a view of, sort of normalized oil prices being a lot higher, and Occidental being sort of the way to play it on a normalized basis. So, historically, what I would say is with oil companies, right, they don't grow at GDP rates, right? They, because the world's becoming more and more energy efficient and we're moving away from oil. So whatever the earnings yield is, I would imagine he's not assuming 4%, perpetual growth rate or whatever, right? And by the way, I'm not even saying that 4% is the perpetual growth rate. I'm just saying that, you could just take that as an assumption. You might say it's 3, you might say it's 5, I don't know, maybe you're a real big believer in AI and you think the world is going to accelerate to 10% GDP growth. I don't know, right? But my point is it just kind of helps you frame what your expectations should be. So anyways, Cameron.
So I think I get a little caught up with the Gordon growth model when earnings per share plus growth is the expected return, right? Is that the basic concept?
The earnings yield.
Earnings yield. So even if you don't get that yield, the thought is that, because not necessarily the dividend, that's going to be reflected long term in the stock price, right?
Yes.
Is that the thinking?
Yeah. I mean, again,
so
as long as you, and again, this gets a little bit technical, right? But as long as the company can retain the earnings and earn a reasonable rate of return, and frankly, given how low interest rates are right now, pretty much most companies can earn 4% in their business or whatever, right? So,
do you see it differently? Like if it's like 1 in the hand is worth 2 in the bush. Like if you actually get the dividend, it's like, hey, that's a little better than it's staying in the company. And when it's staying in the company, they could piss it away. They could use it on something that doesn't work out very well. It's like way over expansion, right? And so you're not actually necessarily receiving.
That's where look, if they piss it away, right, that's a bad return on capital, right? They could also be Google, right? And if they could, Google could retain every dollar and probably make 100% return on that capital, right? It's not a very capital intensive business, unfortunately, is the problem.
Yeah.
But this is the question right now that people have with all these AI companies, right? Is you're investing all this capital, and there's 2 schools of thought, right? Some people think like you're going to create the digital god and the returns on that will be phenomenal. And other people think you're going to, burn it all away, right? And so that's where a lot of debate happens, right? So, the reality of it is that if you told me, if I knew ex ante that the returns were going to be really high, right?
Yeah.
not only would I want them to retain all the money possible, right? But hell, I'd probably want them to borrow and invest even more.
Yeah. Yeah.
You know, I mean, people hate it, right? But like sometimes you even see companies that, you know, cut or eliminate their dividends, right? Because they want to invest because the returns are even higher, right? And you know, the market might not like it, you know, in the short term, but in the long term, it's actually really, really good, right? Because
Oh,
really, you know, you should think of it as when the company is retaining earnings, it's kind of like they're saving on your behalf, right? And if they can
and you
invest
can
it,
force it, right? You can force it, right? You could just have all your dividends reinvested in the stock itself, and so it's just like that,
well,
right? And
no,
you're
no, no.
buying the
But the
shares.
difference, well, the difference is when you have a dividend, when you reinvest a dividend, right? The stock is trading at a premium to book
Yeah, they're
value,
not
right?
actually
Like
getting the money. Yeah.
a company, a company that retains earnings and reinvests it in a factory, right? May be able to make a high return on that retained capital, right? But if you're buying new stock at a big premium to that book value, right,
Mm-hmm.
your return is going to be a lot lower than if the company retains the earnings themselves.
Yeah. Okay, that makes sense.
Okay. Joel, I think you haven't asked a question yet.
Yeah. So mechanically, when you calculate yield, it's net income after tax over price per share, I guess. And
Sure.
net income, do you when you do that, do you use the most recent NIAT, or do you use, because it fluctuates historically over time a bit. Do you take a weighted average or of a few years, or what do you do when you typically do
I mean,
it?
it kind of depends on the company to some degree, right? If it's a company that really is sort of cyclical, then yeah, I'll try to take an average of their net income divided by their most recent shares. You know, if it's a company that's really a growth company, right? That's kind of, steadily growing, then I will just use the most recent earnings.
Okay, got
Right.
it.
So it's kind of very situation specific.
Usually when I look at a company, good companies, obviously their earnings will grow over time, but they
Yes.
may fluctuate. They all fluctuate. They don't stay flat. They'll
Yeah, sure.
up and
I
down.
mean, what I would say is this, partly, Joel, partly, you know, I don't think it matters as much as because depending on how much they fluctuate, it's not going to change your general conclusion of the implied returns that
Got it.
significantly.
Fair point.
But then, the second thing is you can always say, well, okay, the company is making this much revenue. The margins maybe bounce around a little bit. So maybe I take an average of the margins and apply it to the revenue to get a sense of what, normal earnings look like or something like that. But, unless the company's earnings are fluctuating massively, I really don't think it's not going to change your broad conclusion that significantly.
Got it. I'm just going to build a model, so I'm just trying to decide in my head
Yeah.
how I'm going to do it. Okay, good enough. Thank you.
Okay. MD, I think we're back to you.
So my next question is, like, if we assume that G for the market and G for the company is same, what should be the equity yield difference between a company and the market, so that it could be a glaring opportunity that I can reallocate from the market to the particular company?
I didn't necessarily understand your question. Can you rephrase it?
Okay, what I meant by that, for example, S&P is say 25 multiples at this moment, so 4%, and I'm getting from G, say 3%, so total return is 7% from the market. And for a company, I assume also the G would be 3%, but what should be the earning yield that it could be an opportunity for me to reallocate from the market to that particular opportunity?
Oh, I see. Like how much higher? You're basically asking how much higher should the return from an individual stock be versus, versus the market?
Yes, please.
I mean, again, I think that comes to a little bit, it comes down to your preferences, right? Like, you know, I mean, some people will say, if I can make 1% more, it's worth kind of investing in this particular stock. Other people would say 1% more isn't a high enough return for the idiosyncratic risk that you're taking with owning a single stock versus owning an index. But there's no, I don't know at least of any particular like rule of thumb, right? I think if you found enough stocks, you could build a pretty diverse portfolio. And so maybe a small premium is all you really need. But some people like to own really concentrated, investments. And so they might say, I don't want to make 1% more. I want to make 5% more, 10% more, right? Again, there's no like hard and fast rule. Charles, again, I'm just trying to be sensitive to time. So Charles,
Yeah, one thing about Warren Buffett, when he invests, first the portfolio is pretty large, right? 100 million or billion or something. And the second, when he can purchase a preferred stock and convert it. And those type of investment, the size plus the way he had this privilege to purchase the preferred stock, it doesn't apply to the normal investor, right? I mean,
yeah, sure, of course. I mean, look, part of what has made Berkshire Hathaway, what it is obviously Buffett's reputation, and then the fact that they have they have lots of cash, lots of liquidity, right? So when you have like during the great financial crisis, Buffett could write checks that nobody else could write, right? And he was able to get these really good deals, right? Or even Occidental Petroleum, right? They came around and they said, we need $10 billion, right? Very few people can write a $10 billion check, without doing, a lot of work, or even if they did do a lot of work, right? Most people don't have $10 billion just sitting around. So the point is that, yeah, you won't be able to, you won't necessarily be able to find and invest in these preferreds the same way Buffett did. But my point is just to illustrate that, Buffett isn't out there buying just, regular preferred stock or common, convertible bonds or whatever, right? And part of the reason why I think he structures the deals the way he does is because it fits this framework, right? Maybe at some point down the road, you may not have that same opportunity, but maybe there's there'll be some, there might be some financial crisis down the road, and there'll be some small company, some local business in your town that needs financing or something like that. And then maybe you'll be able to do it on a smaller scale, but maybe you'll want to think about it in the same perspective of, a 10% sort of yield plus, upside in the business or something like that. So it's really just about kind of just illustrating, this whole Gordon growth framework, earnings, an acceptable earnings yield, so that even if the business doesn't grow, you still come out fine. And then if the business does grow, which seems, hopefully fairly likely, you'll do a lot better than fine, right? To me, that's the simple algorithm.
yeah, I agree. Right? If you just put one stock over the market, it's pretty hard to find such stock, right? Like a base 10% their year, then plus the growth. Usually,
Yeah,
actually,
again,
even-
that's I don't want to say that it's none of this is easy, but what hopefully it'll do is it'll kind of save you a lot of time from looking at investments that don't meet your hurdle, right? So you can spend a lot less time trying to analyze companies that don't meet your filter, whatever that filter might be. And it doesn't, I'm not saying it has to be 10%, right? 10% may just not be available, right? Maybe it's 7%, maybe it's 8%, whatever the number is. But it's just a number that you have to be comfortable with earning.
Okay,
Right.
thanks. Yeah, makes sense. Thank you.
Okay. MD, you have another question? I think you're on mute.
Sorry. Lot of people say, like I know some of the people, they say that when an index is very high multiple, they prefer to invest in the Berkshire Hathaway because it's a holding company, like an alternative of index. Do you recommend that?
I mean, I recommend owning it if you think it's cheap, right? It's still, I mean, look, it's still a business, right? It's not, you know, it's just a business that owns a bunch of different businesses, right? But you can add up all the businesses together and it's still a business. And then they have a portfolio of investments, right? So you can see what the value of the portfolio of the investments are. And you can see what the, you know, you can subtract that out from the price and you can see what the operating business is valued at. And if it's trading at a very high implied yield, then, you know, I'd say Berkshire is a very interesting buy. And it has traded. It's traded at extremely high yields at various points in time. And then there's other times when, you know, Berkshire doesn't seem that attractive. I listen, you know, I think you could probably you know, do the analysis and, you know, just from what we've talked about in this class, and you can probably have a good sense of when's good times to buy Berkshire and when's not. And then, you know, if you really wanted to go and do a deep dive into it, you can look at how it's performed in history. And you can see when Buffett himself has bought back lots of stock. You know, there's been times when Buffett's bought back, you know, tens of billions of dollars of Berkshire Hathaway in a single quarter. And, you know, times like now when he's bought back exactly zero. Right. So, I mean, I don't think it's actually that hard to kind of figure out if you think Berkshire Hathaway is cheap or not. And like I said, part of it comes down to what sort of returns you're willing to accept, right? So, you know, what I think might be cheap, you might think is expensive, or vice versa.
So basically, you consider it is a business rather than an alternative of the index. That's my understanding.
I mean, look, I think of the index as just a bunch of different businesses together too, right? If I take the S&P 500, how is it different than like me owning a conglomerate that owns all these businesses, right? It's sort of the same thing. And if Berkshire Hathaway is a conglomerate and the S&P 500 is a conglomerate, right? It's just two different conglomerates, right? If you just think about them as two, you know, just two companies that just own a bunch of other companies underneath.
So it could be an alternative that I can take that as a base and then look for opportunity.
Sure. Yeah. I mean, anything could be an alternative.
And another question is like, for the future growth, when you look at the durable future growth, say 4%, what are the factors you look into the company, like which will help you to determine whether the future growth will be close to GDP or like GDP?
Well, I mean, again, I think you need to think about, you know, you need to think about like, is this company becoming more, you know, more valuable as the world grows or not, right? Like there's certain things, right, that, you know, as the world grows, you know, I mean, GDP is basically income, right? It's people's income, right? So, you know, is certain things that, you know, as you get more and more of, right, or as you get more and more income of, you consume less and less of, right? Like food companies, right? Agricultural companies, right? Like you generally, you know, there's an improvement at some point as economies grow, but then as they continue to grow, right? It's not like people, you know, I mean, they eat more, right? Keep getting fatter, but not like, you know, not like proportionately more, things like that, right? Or you know, some of those are like examples of like things like basic needs and things like that, right? But I mean, again, I think these are also like, let's not try to like be too precise with it, right? Like we don't really know, right? You know, people will continue to spend like, you know, right now, right, you would say something like, okay, well, you know, if the economy continues to grow, I think, you know, people will continue to consume and, you know, they'll continue to spend money at, you know, Amazon or Walmart or something like that, right? But at the same time, you could probably also say that like, you know, Target or some of these other companies that might be more competitively disadvantaged, right, may not be able to grow because they're going to continue to lose share, right? So there's all those different kind of components that kind of flow into that, right? I think it goes back to the most important point, right, which is can I invest in this company at a level where I think that it's not, even if it doesn't grow, I'm going to make an attractive return, but I'm confident enough that I know that the business isn't going to go away, right? And then if I get a little bit of growth, great. That's that's icing on top of the cake. It's the cherry on top of my ice cream sundae. And if not, then I'm still fine with the return I got, right? What I don't want to do is I don't want to buy into a business that goes into a decline, right?
So another issue you raised, like last week lecture, that you told us that DCF and the multiples pretty much same thing. Like you can explain it in the paper or something like that. What do you mean by that?
Well, people use PE multiples, right? And PE multiples, you can, again, I didn't want to go through it, but you can basically convert a DCF formula into a PE multiple, right? And that's why what I did is instead I took the DCF multiple or the DCF formula and I converted it to the Gordon growth because that's more easy to kind of use, right? But you can look at the Gordon growth multiple. Gordon growth comes from DCF, right? And Gordon growth has earnings yield. So all I have to do is reverse the earnings yield. And so the earnings yield is just the difference between 1 over the rate of return minus the perpetual growth rate. That's the PE multiple. So it's just to me it's less intuitive. It's just less intuitive. So it's better to just think of it, from the Gordon growth implied return perspective.
So you think like all these three will produce the same result, but it's easier to apply with the Gordon growth model.
I think Gordon growth is much easier to apply than all these other things, but they're all intellectually the same, right? They all come from the same they come from the same basic formula for discounted cash flow, which but I can take the discounted cash flow, I can convert it to the Gordon growth equation, I can take the Gordon growth equation and convert it into a PE multiple, right? But it all comes, it's just mathematical derivations. Cameron, I see. Sorry, again, I know because we're already over time, so I just want to ask Cameron to have his question, and then if there's somebody else who has one more question, and then then we'll end. But again, feel free to submit questions on Canvas. I'm happy to answer them over the week. Cameron, you want to ask?
Yeah. So I was just wondering, everything kind of we focus on in the class is a lot of applying this to all US. We've kind of talked about all US. You also apply this, I assume, to foreign developed international markets. You could apply this to like private credit. You can apply it to utilities, anything that,
that's what I think is power. Look, you've seen this already, right? Buffett applies this to bonds, he applies this to preferred stock, he applies this to real estate, he applies this to equities, he applies this to individual equities, he applies it to how to think about the equity market generally. All from one thing. So you can apply this to foreign stocks, you can apply this to private credit, you can apply this to private equity. There's really no, again, there's nothing that there's I don't want to say there's nothing because I some student will come with some weird edge case or something like that, but I really think that this is just because again all it is it's just discounted cash flow really, but in a much more user friendly format. And instead of you having to look at investments and do all this, build out your model and this and that, which great Joel is doing, but you're going to spend all this time and your answer may not be that different than what we're getting to, right? You know,
Yeah.
like I said, you know, we can look at the market today, and we could, you know, you have these Wall Street strategists who are probably looking at, you know, 100 different macro indicators, trying to think about what long-term equity returns are like. And, you know, we can probably in the course of an hour say, like, or not even an hour now, right? Now you've learned it, right? Like, you know, stocks are priced for 7%, 8%, you know, in that zip code of returns. They're definitely not, you know, not definitely, but very likely not 15%, right? Where we are today.
Yeah. But like US market always trades higher than the European market or, you know, other
Sure.
countries'
Well,
markets in
I mean,
general, right? So you'd have like a different standards even that you hold, right? Because everyone seems to believe.
You might.
Yeah.
Yeah. Yeah. I mean, but again, that's just like you're looking at different markets and different like levels of rates of return and opportunity cost again.
Yeah. Yeah. Okay. Makes sense. Thank you.
Okay, guys. Well, I don't see any other questions right now. Again, like I said, you know, feel free to submit something on Canvas if you guys have questions. The readings for next week should be up. Again, don't go crazy on the readings. I'll spend a lot of time walking through the history, but it's interesting to think about what Coca-Cola looked like, and it'll be a good. Hopefully, it'll be a fun class. It's fun to put together. So. I'll see you guys a week from now. Thank you, guys.
Thank
Thank you
Jeff.
very much.
Bye.
Bye.